Europe's debt crisis and financial reform in this country are just two of the reasons that equity investors have been sent on a wild ride recently, not to mention all the concern we've seen with corporate bond sales and with currencies. Joining us now to talk about how he's viewing stocks in this unsettling environment is David Chalupnik. He's Senior Managing Director and Head of Equities for First American Funds. He joins us this morning from Minneapolis. David, given that you like consumer discretionary, this existing home sales figure this morning has got to make you feel good.
Yes, the U.S. economy continues to move forward. The consumer is spending. The consumer is starting to repair themselves. So that's all good news. So we certainly do like the consumer stocks. We do like stocks, more U.S. based, obviously with the problems and issues going on in Europe.
But the caveat to that is that perhaps sales were pulled here, given that the tax credit's about to expire, and it sounds like consumers just ran out and picked up as many homes as they could. Will they follow through, given as well some of the concern that we're seeing out there about banks lending and corporate bond sales being weak?
Yes, with the consumer, so you are starting to get job growth, so that certainly helps the consumer and housing. Mortgage rates are down. The tax credit has expired, so you can see a couple months of sloppy home sales, but longer term, the consumer is improving, and with that should help. The house market prices are down quite a bit for housing, lower interest rates, consumer coming back. Longer term, the housing market should continue to improve. It's going to be a bumpy ride, but it should continue to improve.
So how do you convince your customers, though, that they shouldn't be quite as nervous as some might be, given the swings in volatility we've seen lately?
Yes, we've had huge swings in volatility. We expect volatility to continue to be very high. So that is the negative. That's the tricky thing. If you do look at the market, or if you do look at specific sectors and stocks, you really do have to say a couple things. One, with the market overall, the U.S. economy does continue to improve and grow. Number two, U.S. corporate earnings have been stellar. And if you look at the valuations of the market, it actually looks quite interesting and quite compelling. So from a longer-term market look, we are bullish on the U.S. equity market. Within specific sectors, it's really a similar type of analysis, where you look at the earnings power of consumer stocks, of financial stocks, you look at current valuations and kind of what's going on, and overall the trends are improving for both of those sectors. So that does make us bullish on a longer-term basis. But having said that, Margaret, yes, volatility is going to remain high.
Why do you like regional banks, given the forecast that we've heard from the FDIC as well, to bet on more failures?
We like the well-capitalized regional banks. The banks that have raised capital in the open market have paid back TARP. So financially, they're sitting on a pretty good balance sheets. They will begin to lend, and today the biggest reason we like them is their credit quality is improving pretty dramatically.
All right, we'll continue to monitor it. Thanks so much, David.